Hello and welcome to another episode of Investing with IBD Podcast. It's Justin Nielsen here, your host, and it is December 11th, 2024. And this is actually my Scoutmaster's birthday. I just remembered that. So happy birthday to my old Scoutmaster from Troop 9 out in Riverside, California. We've got a great show for you today. We're introducing to you a new guest to the podcast, Leoš Mikulka. How are you doing, Leoš?
Good.
Good.
Thanks, Justin. It's an honor to be here. I mean, coming from an IBD style background, with a IBD being my first instrument when I started trading about 8 years ago. So it's an honor to be here on this podcast. Watch it every week.
Well, it's an honor for us because for those that don't know, Leoš has been killing it in the U.S. Investing Championship. He's been doing a fabulous job, and that's not his only job. He's actually, he's got a full-time job. This is something that, trading is something he does on the side. Now, lucky for him, or, some would maybe debate that, he's in the Czech Republic. So what he does is he just, does his job during the day, and then 3 p.m., that's when the market starts for him in the U.S. Now he's joining us right now. It's 11 p.m. at night for him, 2 p.m. Pacific time for me. So we've got some time zone things, but that's the beauty of the internet, right? We're all a global community here. So appreciate you coming out at so late at night.
That's no problem. I mean, I'm used to these hours now. So
Right, exactly. So this is just stretching it a little bit. Well, let's get right into it because I think the big thing that people want to know when someone sees the performance that you have, and just year to date, what are you at for the championship right now?
year to date, I mean, the results have not been published yet, so it's not official, but you can see it in a description here. I'm around 900%. So
900%, right. So that's two zeros behind that. That's a huge percentage. And of course, when someone has that kind of performance, people want to know how'd you do it. But maybe you can start a little bit because you mentioned that IBD was kind of your first initial introduction into the market. So maybe you could start a little bit with your background and how you fell into trading.
yeah, it was. Yeah, I started about 8 years ago, and what I started with was, as I mentioned, like my first resource was the how to make money in stocks and the IBD. So I was getting the IBD newspaper basically, and only thing I was doing, I was just basically grabbing all these charts from IBD 50, IPO leaders, stock, the sector leaders, and all these lists, and I was just putting into my manual, let's say, notes or text files and so on and so forth. And I started with this classical, like trying to identify cup with handle, flat base, and basically nothing extraordinary. Just looking at trying to look at fundamentals, earnings, sales, and really what the O'Neill was teaching in his books. And then later on, like in the years afterwards, also IBD came with that option to export all the
Hmm.
names from IBD Digital. So at that time also I didn't want to really, because the my resources were scarce, so I didn't really want to invest too much into other tools that I didn't know since I wasn't profitable. So buying like market search, that time Market Smith was really not an option for me. And so what I just did, basically I took all these names, put it into my own Excel spreadsheet, and I would put like my own screens on it, just sort it by relative strength or some other parameters, and then I'd be going through it every week, on the weekends, week by week, just marking it like 8 weeks, 6 weeks, first base, second base, third base, and cup fit handle and all these patterns, and then trying to identify later on as you progress, as you advance in your career, you start looking more into those nuances, also like some advanced pivots, pullback buys, and all these criteria.
Hmm.
And at that time, maybe I was when I was doing this, week by week, at that time I was kind of thinking it might be waste of time, just every year, just every week, spending just a huge amount of time just manually marking the charts. But when I look at it now, back like 5 years back, it was maybe the most beneficial thing that I could have done, going
Yeah.
just through the charts manually.
Well,
And
you know what? It's funny because, there's a lot of stories of these manual processes that kind of really do great at training. David Ryan, before he won 3 back-to-back U.S. investing championships, was talking about how he was Xeroxing, the charts for model books, and he was just making copies of charts, and that's how he kind of learned, hey, these are the patterns that you got to know. Tom Dorsey, he was talking about how he marked up those point and figure charts, and it was all manual. And even Bill O'Neill, as much as he had these screening materials available to him, he a lot of times was using the paper. He was just going through the stock tables and recognizing, okay, what things were up the most, what was the volume like, and so yeah, I think sometimes the tedious part pays off in the end. So it sounds like that was the case for you.
Exactly. If you just focus on price and volume, that's all you need. You don't have to bother with all these other technical indicators like MACDs, RSIs, and so on and so forth. And of course, it was not end of the journey. Then I joined also the Minervinis platform and the program, which provided again like a little more like the microscopic view and really build a solid foundation in the risk management and how to handle the exposure and so on. And currently, since also I don't have really a trading community around me here in Czech Republic, I'm a member of a champion team trading with Leaf. So with Leafs already, so we share a lot of ideas there. Also, trying to encourage the like-minded traders. So maybe also I would recommend like if there's anybody like me that needs to build a community and
Mm-hmm.
come to join us. And
Well, and I guess that's the good thing, right? We have all these communities available. I mean, we've got a great community here at IBD. You've got the championship, the Minervini. Again, we're all kind of using a similar system, but there's a lot to learn about how to use that system and how to make it kind of your own. So maybe you could get into some of the details of, you know, what was your learning process like, and where are you at now? So now that you've gone through that manual process, you know how to recognize the base patterns. There's certainly those elements of position sizing and selling rules, implementing the rules. How did you kind of get to the point that you're at now, where it you know again got you the performance that you're looking at today? Are you more, first of all, before we get to that, maybe I should ask, are you more of a swing trader, position trader? What is kind of your time frame of holding?
I'm more of a swing trader and leaning on this shorter time frame. So
Okay.
currently, if you look at my statistics, my average time for winners is about 15 days. For
Okay.
losers, it's gonna be maybe like 6 days, 5 days, something like that.
Hmm.
So, but of course, it's average. Of course, if there is a big winner, I'm able to hold it for 3-4 months. But cutting it short is the main factor. So.
Hmm. So again, that does take some of the IBD traditional style and squish it down a little bit in terms of time frame.
Exactly.
So
I mean,
what kind of led you to that, and how are you making your buy and sell decisions with that shorter time frame?
I think it all comes down to, as you go through your trading career, kind of like trying to build in what fits you the most from a mindset perspective, and also that it works in the math, in the stats that you're comfortable with, right? So also traditional started, trying to classic David Ryan, Bill O'Neill, trying to hold the names for 1.5 year and trying to hold it for a little longer. But then also I started noticing like also later on the math, like the risk reward ratios didn't fit very well. You have to adjust and find you know let's say the space where you're making the most gains. So
Hmm.
for me it proved to be like this kind of a midpoint, of course not that short as a day trader, but throughout the years I was kind of shortening my time frame since I'm very bad at selling at the tops. So I'm very quickly de-risking at least first portions of my positions into those first breakouts, and later on trying to free roll as much as possible.
Yeah. And I guess a big benefit sometimes to that swing trading idea, and again, if you're not holding as long, is that you kind of reduce your drawdowns. Have you found that to be the case?
Absolutely. And maybe also like maybe one nuance that maybe might help some traders, like what I try to do with these positions that I'm really like locked in, that I'm convinced that it's gonna be big winners. I kind of try to keep I try to visualize things also, like try to put on a paper really, like, these buckets that I have. Okay, this is a 20%. I have here like the 5 buckets, which makes 100% total. And in this last bucket of tiny positions, I try to keep these free rolling, maybe 2% positions, which will equate at the end, maybe, quarter of my portfolio, because
Hmm.
I don't want to lose a touch with the name.
Yeah.
And
Yeah.
the point of the risk management, it's not something that I really have like almost in front of me like every day. It's like kind of thing of my daily routine that I'm kind of keeping. If I get stopped out on all the positions, what's gonna be the worst case scenario?
Hmm. Right. Totally makes sense. And again, risk management is something that is just a theme that you hear from so many great traders. It's, from Warren Buffett, long term to the shortest term trader. If you don't have the risk management, then you just don't usually stay in the game for very long. Now, another concept here that I think is interesting about how you do what you do is you talk a lot about themes, but not necessarily how most people think of themes. A lot of people think of the fundamental themes, a thematic approach. Okay, I'm really focused on AI right now. That's the hot thing. But for you, it's not just about the fundamentals, it's also about the technical themes. So could
Yep.
you
Uh,
kind of describe what that is for you,
yeah,
technical themes?
absolutely. I mean, you have always like theme can be various things, right? Theme can be, as you're saying, it could be group, it can be a sector, it could be a type of a name, it could be mega caps, small caps, it could be new IPOs from this year. And then you have the themes which are technical themes. So always, of course, unless the market's in bearish territory and nothing's working, you always have the kind of the set where you have the most probability which might work at a time. You can see it easily from your watch list. If you have watch list of few hundred names, you see how they're behaving, so you can see like what is the most common occurring pattern that's working right now. It can be, for example, throughout this year, starting in a Q1, there was, as we were turning into this stage two uptrend in many names, you found that a lot of pullbacks started working. A lot of names were finding the support at moving averages. And if you combine it with the group sector theme, these two together, it can produce like a dramatic result over time. So, for example, if you have this chart here, it was around January, February. You could see a lot of the names like retracing back. For example, ARM was the one that I was trading, and you had a precedence of SMCI and NVIDIA, which was a group theme which were rocking at the time. And SMCI came, uh, sorry, ARM, yes, you can see the SMCI rocking, and then the ARM, if you look at back at the chart. Uh, I traded it first. I traded it from the IPO from before, but then before the earnings, yeah, you had you had this, and then after prior to the earnings, on January 5th, you had this when the name retraced. I think it was a 21-day, 20-day moving average. It found the support there, and it was very like trading near a danger point. So my total risk at that point was maybe 2%, and very quickly, like it found support very quickly. I was maybe 5-6% up, and from there you have a lot of leverage. What do you want to do with the name? You can take a
Hmm.
partial profits, you can move your stops. If you're really short term, you can just also just turn it over and buy some other name.
Hmm.
So this is
And since there was such a huge move on earnings here, maybe we could talk a little bit about that because for swing trading, sometimes earnings can be such a wild card, right? Especially, I mean, this earnings season, we've seen some phenomenal moves. 20%, 30%, 40% has not been out of the cards for a lot of these stocks. But at the same time, you can see some really ugly moves to the downside, 20%. And for a swing trader, that can be really devastating. So you kind of had a little bit of a cushion going into that earnings report. So how do you handle earnings? Do you scale back or what do you do?
So at that position here, because I had, as I said, first my first position was from that the base prior, so it was already going back into 2023. And I added on at this point that we just went through. And going into earnings, I descaled like most of my positions. So I was back maybe to 1/3 of my original position. And yeah, it also, as you correctly said, there was some cushion that
Hmm.
even if it kept, I mean, the option market was not showing that, of course, we're gonna gap up 50%. If we gap down 50%, of course, it could have been a little bit more damaged, but still nothing that it would destroy my account,
Right.
right?
Hmm. And so you scaled back. Maybe it's a good idea to kind of get a sense of your position size. Some people go with a lot of positions and keep it small. Some people go with large. What is your rough position size that you're going with on a lot
So
of these ideas?
my optimal is 25% of my portfolio.
Okay.
Here, however, it was lower because going from the 2023, I was going into a year, I was almost in cash. So here I was
Hmm.
just starting to build up the position. So here maybe my original might have been maybe like 10, 12%. So if I took it down like 2/3, it was maybe to 4% of my portfolio or something like that.
Hmm. Right. And then are you kind of scaling in and scaling out of positions? You're
Uh,
taking profits on the way up, or are you adding to things as they're working?
Scaling up and adding up, it's always like I try to approach it as a new position. There's always
Okay.
must be a reason. There must be proper pivot developed. I won't just like blindly, add to my
Add
position.
because it's up.
Yeah, exactly.
Right.
That's also
Okay.
one thing maybe a lot of new traders are struggling with, just that FOMO, seeing the name going up and trying to chase everything.
Right. Well, you know what? That brings up a great question. So let's maybe shift gears, and for this segment, we can kind of get into the current market because you kind of started this conversation with kind of a theme of how, okay, in the first quarter, this is what I was seeing. I was seeing some really big moves, and then I saw a pullback, and so maybe you can walk us through that. Here's the Nasdaq Composite. Are you using the market indexes that much, or are you kind of we talked about this. Sometimes it's almost like you want to build your own index of the stocks that you're watching to get an idea of what's really happening under there.
Honestly, like I don't watch it during the day. Of course, I have a sense of it, but I look at it at the end of the day. I try to avoid queues because, first of all, it's heavily weighted. You have
Hmm.
100 names, so I think from your watch list, you can easily pick up few winners, which will make your own index, which is looking great. But looking in a bigger scale, of course, I will look at Nasdaq Composite, but I will also look at the like mid cap index, like MDY. I would look at small caps like IW or the IWP, where I'm looking, which is like the more concerned in the growth. Uh, yeah, I would look, of course, at S&P. So, trying to build a bigger picture where we are, which
Hmm.
also it will show like also that ongoing rotation that we're going through, right? It's been talked about like since I don't know how long now, like every week.
It feels like years at this point. Yeah.
Yeah.
But how do you kind of recognize that sector rotation? One way is by, I guess you can start at the kind of that large big picture view, small caps versus large caps. But do you ever get down to like the sector spider ETFs? Like here's XLY, the consumer discretionary, which I do have a position in this, versus an XLP, which is the consumer staples, which is considered a lot more defensive. Are you kind of going to that level, or again, is this getting more to the individual stocks?
I will get to those, but again, as you're saying, coming from individual stocks, so I'll be looking at the individual names, which will lead me to these groups, which will lead me to general index, right?
Hmm. Yeah, makes sense. Well, you know what? Maybe we could also talk a little bit about, as part of this trend idea. One of the other things that you mentioned quite a bit is how you're kind of using different indicators. Again, kind of getting a larger sense of what's happening. And you brought some slides to kind of share with the class. So I'll bring these up. And first of all, In Market Surge, we have we partnered up with Mark Minervini. He uses Market Surge a lot, and we partnered up with him to come up with a screen. And again, you kind of created a manual process here where you're just tracking what this screen is producing. So maybe walk through a little bit of what this tells you by doing this tracking.
So yeah, first of all, later on we will also look at some secondary indicators which I look at usually when we're getting into a area like now when it seems to be getting a little bit frothy and so on. But from um, these slides here, it always like tells me where we could be in terms of a trend. Right?
Hmm.
If you look at the beginning of a year, you could see that 1 month it means like the 200-day was just starting to trend up in many names, which then were washed out, which later on like didn't really like increase again. And you could see that 5 month, it means a lot of the names also started turning from that 1 month uptrend to 5 month. It means the longer sustained stage two uptrend.
Hmm.
And as we're going through, you can see the numbers, the increasing. What will be on the next slide and what we use at a champion in trading, it's a little bit more, let's say, filtered out. So we filter out like the lower priced and lower volume names. So we get a little clearer picture of the names we're trafficking in. And from that perspective, you have to keep it relative, right? We don't look at exact numbers, but if you look like recently, we've been going really into frothy levels in terms of extreme spikes from those names, which could indicate we could be at a turning point. Uh,
Hmm.
it doesn't necessarily mean we're there yet, of course, but it's something to keep in mind and take into perspective with like some other indicators and the index behavior at that time.
Hmm. And which trend was this taking? So this is excluding low price stocks, but is this taking the 1 month or the 5 month?
This is like it's not directly taking the trend template, but it's based on the same principle of the 5 month.
Okay.
Yeah, so it's not
So
like direct copy. There's of course some nuances of that Leaf put in it.
got you. Okay. And then also, we just had the Bulls versus Bears, come out again. Comes out every Wednesday, and this, of course, is from Investors Intelligence. Um, it's kind of getting up to levels that are typically associated with a little bit too much optimism. So, how do you use this indicator? Because a lot of times it's not a great timing indicator to tell you, oh, it's a top, but it kind of says we might be close.
Yeah, it's coming to with a combination of that previous slide and the general like behavior of the names. So, for example, currently, yeah, what I could see is a lot of these names that broke out from the first stage, second, third stage base have progressed through like the uptrend and maybe one, two, three natural reactions have
Hmm.
not formed any further basis. So there is a time that eventually they'll have to build that base, right? To mm, to shake off a little that excessive bullishness. And if you put it in a perspective with secondary indicators like these ones, it gives you again a little bit more conviction, a little bit more probability that it may be an intermediate trend in few weeks, few months going into 2025, we could be getting into some turning point.
Hmm.
Historically, yeah, as you mentioned, going over these 60 years, I think we're approaching like 5 year high from the bulls ratio, which is really like excessive bullishness in the market.
Right. And then walk us through this one. So NAAIM, what is
Yeah, I
that?
am in. This is advisors again, the exposure index. Uh, why I brought it here, it's kind of interesting to look at since in a bullish bears ratio, we are getting into excessive levels. But from this one published last week, we still have a little bit more room to go. So there's something saying, we might get that Santa Claus rally that we're all waiting for.
Hmm. Yeah, and I mean, of course, a lot of folks are looking at that as one of those seasonal, uh, times where December, October tends to be a lot of bottoms. November tends to be a good month, and into the end of the year, especially on election years. And this is something that we've talked about with Jeffrey Hirsch from the Stock Traders Almanac. He's the editor over there, and he'll be joining us in February to kind of talk through, our year in review and the year ahead. So yeah, the Santa Claus rally. I think this year the expectation is it would, we're typically looking at December 24th through the first, couple days into the new year. So how much of that seasonality are you using? I mean, if okay, I've got these headwinds of what typically happens, but I've also got on the other side the tailwinds, or I guess I'm sorry, tailwinds for the positive stuff on the seasonal side, but you've got the headwinds for frothy sentiment. So how are you kind of matching and deciding what to do when you've got those contrary indicators?
Yeah, I mean, it's more like being on the lookout what could happen, right? So it doesn't necessarily mean like I have to immediately like reverse my positions and so on, but having the statistics in mind, I'll be leaning a little bit more with the probably decide that something good could happen in the next upcoming days.
Hmm.
However, if let's say put it in a way that we would be, in some neutral bearishness and neutral bullishness, that would put me a little bit more on the side of being, bullish going to the year end. With
Right.
these factors coming in mind, I'm more on the lookout that I might have to be quicker, to start scaling off and peeling off my profits and, taking maybe some small losses before the damage occurs.
Yeah, makes sense. One other thing, we've got the a few other sentiment indicators here, um, and
This is just to quickly highlight again a little bit those mixed views of how various advisors might be like approaching what's going on. Since in that previous slide we saw some indicators showing extreme greed, you have some other indicators showing that might be some fear in the market. So we're not at those extreme greed levels yet.
mhm. Okay, so you're just again, you're really looking for the extremes. Do you use negative sentiments in terms of telling you whether things are um, potentially a little bit more bullish?
Absolutely, yeah. I use both sides. I think I don't really make a difference. That like some traders might say, the bullish might give you a little bit more conviction than bearish, or the vice versa. I don't really see it that way. I'd be
Hmm.
approaching it exactly some way, looking at the extreme levels at both sides.
Hmm. And look, we've got to address real quickly. I'm going to go back to the market surge chart. We've got to kind of address that as ugly as we kind of saw a lot of the growth getting hit. I mean, it really wasn't getting hit that much on the indexes. They just really didn't show that much. But I mean, if you looked at like our style, IBD style of investing, here's the Innovator IBD 50, and I mean that had a 4% loss on Monday, and then another 2% loss on Tuesday. So we were definitely seeing a lot of the heat getting hit. App Lovin, which arguably was one of the big leaders, starting on September 11th, when things kind of turned. I mean, that was down pretty quickly, getting support now at the 21-day moving average line. So again, if you kind of had a lot of these things telling you sentiment was a little frothy, what action did you take as a lot of these high flying stocks, a lot of the heat were coming down so sharply?
So I was going already like pretty light going into this week. So I was kind of prepared that something like that might happen. Of course, it wasn't as nice and pleasant. So of course also I got a little bit hit and suffered a little bit heat in my portfolio, but nothing too dramatic since I was a little bit protected. Yeah, so it comes, yeah, always with coming prepared what might happen. It's not we're not in a reactive business really. If you're coming into a day, you should have a plan what might be happening and how you're gonna react to it,
Hmm.
including your worst case scenario.
Hmm. And how do you kind of do that for yourself? When you're looking at that worst case scenario, I mean, there's certainly like the technical levels, but of course, some of these stocks gapped down considerably, and so sometimes you don't. Sometimes you might misjudge how bad it can get, how quickly.
Yeah, of course. I mean, that's why we use stops, right? If we get stopped out on everything, then we're out. But again, it's not just black and white answer. It's a little bit of art into it. But it comes first from, if we look at the stops getting hit, then of course you might see that something bad is happening in your portfolio. So you might have to, if you're overexposed, you might have to, pull some breaks also on some other names and de-risk your portfolio as a whole. You know.
Hmm.
And you don't necessarily have to. When I'm saying the risk, you don't necessarily have to take immediately the names out. You can always again move your stops. Just since also I'm working full time, very often also I use hard stops. If something like this happens, if a name gaps out, unfortunately, then I'm out a little bit of slippage, but at least nothing worse happened.
Hmm. Right. There's something to be said for a lot of times after you've been doing this for a while. Sometimes, yeah, taking a loss is almost a relief because it's like, okay, well, it didn't work, but at least I kept it small in a lot of cases.
But and again, it's gonna be a little bit individual, right? How much can you stomach, right?
Uh-huh.
Somebody's, and how much gains have you gained recently, right? If you gain, if you're trading larger, you're a fund and you've gained 10-15% for a year, you probably don't want to give 10% back.
Yeah.
If I'm up 900%, I can afford to, even though it's not pleasant, I can still afford to lose 10%.
Hmm. A few more slides that I wanted to get to that you brought to share, and we'll start off with this rotation idea. So you kind of created a grid here of for those that are maybe listening to this, I'm just going to kind of describe it. On our y-axis, we've got large, mid, and small, and then on our x-axis, we've got value, core, and growth. Um, and then you've got kind of a 9 square grid. So how do you use this, and what is this telling you?
And not to take all credits, it's actually created by our team member Derek. So I just took it from him. But these slides, it was just I wanted to highlight the ongoing rotation that we have. Right. So
Uh-huh.
you have the percentage gains or losses per that time period. So here we have 1 week performance and how in general the large value versus growth were behaving. And here on the bottom we have the mega names, small names, and so on and so forth. So you'll see, the first week of December, we have this huge rotation back into the Mac 7 and all the mega names. On the next slides, you will see what was happening in November underneath the surface. You, on the other
Hmm.
hand, had mega names lagging, small cap, mid cap, micro caps were firing.
Hmm.
So this again just shows you, you might have to be a little bit quicker this year.
Hmm. And I guess so walk me through how you use this, because for some people the rotations are coming so quick that if you kind of look at, oh, mega caps had a good week, or that's what's in favor, because of the relative strength, by the time you start buying it, it's like, oh, now we're moving to the small caps. So how do you kind of use that in order to gauge, not just where the puck is, but where you think that puck is going?
I think from me personally, I think it fits pretty okay since like my time horizon fits perfectly where these rotations have been occurring. So I've been hitting kind of these sweet spots where to get in, where to get out.
Hmm.
But of course, maybe if, let's say, if we would have sustained trend in certain of those categories, like the mid caps, then of course, again, I would be a little bit more. My watch list would probably contain, I would be putting much more preference to these names, and I would kind of be putting those mega names into the background. I mean, my wish is that we get some new, let's say, fancy abbreviation instead of Mac 7 Fang, that we get some new leaders coming up, and next year we'll be talking about a new group that nobody's heard of. But
Hmm. Right. And then this is such an interesting graph here. So this is something that you kind of created. Um, so let's talk a little bit about the distribution of how your profits and losses happen. So, first of all, I think it's important that people realize, especially if you're new to this, um, it's not linear, right? Your 900%, I'm sure, did not come from just like a steady movement. Did you have certain time periods where it was like you were really killing it, and then okay, now it's trying to keep what you've earned, uh, and not
so
not give too much away.
yeah, so let's start maybe from the negative side. I think it was in throughout the summer, since also the market wasn't very good, and it was also a combination that I started getting kind of my first attention, right? So people started noticing, and I got into this mindset somehow that now I cannot disappoint. I have to be pressing the gas all the time. But luckily, again for me, what I was able to do since I started accumulating losses, I started taking smaller and smaller positions. So
Hmm.
actually, if you would see this distribution in, I think it was July and August, at one point, I think I had maybe 16 losses in a row. And I still produced maybe like 15%, 16% drawdown, which is, it's a little bit excessive, but nothing that you wouldn't be able to recover from.
And that's because you kept the losses small.
Exactly. And what I
Hmm.
wanted to highlight here is, people think to have such a dramatic return, you need like, I don't know how many 10 baggers, and you need to have all the names going 100% and more. Well, it's really not the case. It's all about moving that alpha, the distribution curve, just a little bit to the right. More you move it to the right, the higher returns you'll get. But of course, set there the wall at around what your maximum stop loss is. It might again differ. Day traders might have 2%, long-term investors might have, I don't know, 7%, classical O'Neill. But try to be increasing the distribution on the right, and keep the middle steady, and eventually, it's all about small steps. So
Hmm. And it looks like, again, if we just kind of um, you know visualized a wall right here at that 8%, 7% level right here, you can see that definitely the majority of your losses are actually right there in the 2% range. So again, very small. And to your point, the more than 40% gainers, not a lot of them, but enough to really kind of, again, a lot of small gainers here, and these are just more than enough to kind of get you the performance that you've experienced.
yeah, also those lot of those small gainers then came as I started trading, like increasing the positions in the competition like heavier and heavier, then
Uh-huh.
I would be much less willing to lose, right? So if really like heavier positions start reversing, I would be just taking those small gains, trying to keep moving that curve. And of course, I can always buy the name back, if it acts right. It's nothing stopping me from doing that. I'm
Hmm.
not a fund that I would have to be scaling from a position from weeks. I can just turn it with a click of a few seconds. So,
Yeah. Okay. For this segment, I want to kind of get into some of the stocks that are on your radar, and you can kind of share what you've the lessons that you've shared with us so far, and kind of go to an implementation, if you will. So we can start out with GEV, and I actually have a position in this myself. We put this on Swing Trader, our Swing Trader product, but I mean, this has been one of the strongest stocks out there since this spinoff happened. GE, of course, we have a long history of GE, and this just kind of split off into GE Vernova, GEHC, which is the GE Healthcare, and certainly GE Vernova has been doing very well for a while. So walk us through what you're looking for here. Is this one that you've traded already?
yeah,
Um,
this is
do
one
you
that
own it?
I traded, and I tried to get back on last week. I'm still in that position myself. My stop held, so far so good.
Okay.
Yeah.
And what is it that you're? when you're looking at this, are you looking at the daily chart mostly, the weekly chart?
I'll be looking at both. I'll be looking at daily and weekly charts. I have from GEV. Let's maybe come back to that story first, right? It's spin-off from GE, but traditionally it's coming from a wind turbines and all this wind energy, right? But also part of the subsidiary of the GEV is also GE, the nuclear, which is so GEV is now getting a lot of the nuclear space, which have been talked about recently a lot, also in relation to AI. Of course, for AI, you need the power and you need to get the power from somewhere. And if you look at also the fundamentals of the GEV, they've been stellar, like quarter after quarter, the EPS, as you see here, 965, 44%. It's a steady fundamentals coming in. And from the technical point of view, that's exactly what I was describing earlier, right? We have here the first IPO base, and since then you had a few natural reactions like on daily charts, but on a weekly, basically you can see almost that David Ryan MVP criteria on a weekly chart. You have just multiple weeks up, all the good closes, good increasing volume on weekly, but eventually, as you get overextended, you'll need that second base, and that's what's happening right now. We're about a 4 weeks base for the newer name. Maybe you can shorten the time frame of those bases a little bit. You don't necessarily need for a newer name like 8-10 weeks base, but we will see. Of course, I think it still needs now some sideways action, but I think it has still going in 2025 very good potential to continue.
Mm-hmm. Very good. Well, you mentioned nuclear and the energy, but this is kind of in a different space. When you say NN, it's so funny because I think I shared with you that I think of the old Nortel networks from the 90s that was a high flyer, and you can't even pull up the symbol anymore because it no longer exists. It was sold for parts. But this is kind of a lower liquidity stock. So maybe we could talk a little bit about your liquidity requirements. As individual investors, we have a lot more ability to get into some less liquid names, but there's always the risk of volatility. One big player can jump in and really kind of move these stocks. So do you have like a liquidity requirement for yourself?
Not necessarily like a certain liquidity set in stone, but of course, that we go into a really micro caps, I'll be trying to like avoid them unless I see some really like powerful technical patterns like we're seeing here. We got from that lower priced category into about $17, which at least we're getting into the area where, if maybe some institution wants to jump in, there could be some chance. So I'll be looking like if the lower I go in a liquidity, the higher RS I would require for a name. I would not be trying to bottom fish, lower liquid names. And again, here it comes with a combination of let's say the technical theme, which we have here, like high tide flag setting up. As you can see, we've came from this period of dormancy about, between, $6.50, $8 all the way now to about 15. And you can look now at the whole base, basically now those 4 or 5 weeks as a one high tide flag. We tried to come up, we stalled, and now we're pausing for the third week exactly on that resistance, on that supply level, staying very tight. We've got enough time that the moving averages have caught up, like the 10-20 day moving averages have caught up. So there's some potential for the name to burst further. We'll see, there always might be some under a shakeout, which could be still useful, but I think there's a potential for this.
Mm-hmm.
Of course, the lower liquidity, it's not going to mean that I would increase my risk just because it's lower liquid names. It's going to be the exact opposite. The less liquid, the more stringent I'll be on the risk.
Right. And then I thought we could kind of end with one that has been another high flyer. And again, this kind of shows how quickly some of these high flyers can come down. So IonQ, of course, they're into quantum computing. Alphabet announced how they're kind of getting into the quantum computing, some partnerships there. And the weekly chart here just looks, incredible. Such a strong move. I mean, this went from basically $7 up to 30, 35 and change. Huge move. This week, this is only Wednesday, and it's already down 22% from its peak. So um, I guess the first question is, and you don't own this right now,
No.
so it's a lot easier to watch that from the sideline, saying, okay, maybe there's a setup happening when you don't own it. But for people that own something like that, how much are you willing to give up in order to stay with a position?
Yeah, honestly, like looking at these names, I think it will be very difficult to stay on board for this whole uptrend. You can see even also those undercuts of that 10-day moving average, and now we broke for that support today, of course, and that huge spike down. And again, it of course comes to personal preference, how much you're willing to risk. But then, of course, I'll be also looking on a clues in times of the price and volume. Like, do you have any reversals? Is there maybe some low volume coming up, higher volume coming down? Are we having good closes, bad closes, and also looking those technical cues that could help you identify, if you might have to be starting to cut the position a little bit, or if you can just, ride the trend. But
Hmm.
very difficult to stay on board. I think from the technical perspective, I think a lot of people could have thought, okay, it's, when we got into that first area, it was about 16 that moves over, that we already ran up from 6 to 60 in a huge move. But if you zoom out on the weekly chart, then you can see basically that we were just turning to that first, it was basically this huge base was a if you want to consider it as a base,
Hmm.
then we were just getting into a first leg of that uptrend. So now I'll be carefully watching going to a new year. I don't think looking at the action today, I don't think there will be any actionable pivot anytime soon. But fundamentally, I mean, I'm a big believer in quantum computing. I also looked up, some interesting data about quantums. For example, that they said like some simulation for, traffic for 10,000 vehicles that 10 GPU NVIDIAs would be doing 24 hours. These few of these Cupid quantum computing can solve it in maybe 1.5 hours or something.
Oh,
So I
wow.
think it can really be a game changer. I think in terms like AI, quantum computing, and all these pieces of puzzle coming together.
Hmm.
From a
So
fundamental,
so this is on the watch for you.
this is
And again, it doesn't bother you that something like this has come up so much. You still think with the appropriate amount of pause, it could have another run.
it's exactly it's I think it's advantage. That there are some interesting hands trying to get on board in the name. You just have to give it a little bit time to we cannot go to infinity.
Right? Yeah. So you know what? I'm gonna kind of surprise you a little bit because we have a little bit of time in this segment. Are there any particular big winners that you've had this year that you want to kind of share how you handled it? Is there anything that sticks out to you that was like, wow, that's kind of the one that really helped out?
Well, the GEV actually we discussed as a big winner, but I don't know if you want to go back to it. Or then also Kava was one, which was very
Okay.
easy. It was very easy to hold. Uh,
And are you still holding this one or
Not anymore.
not anymore? Okay. Yeah, I mean, a lot of us were holding this as well. The break of the 50-day moving average line certainly, wasn't that great of a look, but I mean, we were kind of a little concerned at this earnings move that reversed so much. So how are you handling this one? And I can go
So
to the weekly chart if that helps.
so basically, I was trading it basically from around that about March area, and I traded multiple times.
Okay.
Uh, so I read into the first like up, then I got shaken out because very often when I start peeling off the position, I'll start putting my stops around the moving averages and some technical patterns, like some natural reactions and things like that. And this nature of the kava was kind of a lot of shakeouts. So many times I've got shaken out, but there was still the action was still good. So many times I just entered right back. For example, if we go on a daily chart, uh, the interesting point was those earnings in May, June, when around that level, when I held some piece into the earnings, and I got shaken out on some part. Uh, I As it started approaching the moving averages, I actually jumped right back, because still the risk from that new position was maybe about 3%. So still a good, the lot of volume was coming in the day, from the scare, and that remaining position led me to hold it from all those areas before, all the way over that 90 level. And I think then last time I got stopped out here was on that 50 day. It was my last part after that 98, when we started breaking out from the first base.
Mm-hmm.
Yeah. And then I entered again exactly there as you have the mouse. So yeah, and uh, I think here I got stopped a little before earnings around at 129, when it started coming in all the way into 129 prior to the recent earnings. Yeah, that
Mm-hmm.
scared me off going to earnings, and yeah, unfortunately, could have been even bigger, but
But I mean, what's interesting so many times is you get shaken out with something like this, and you look at it a few weeks later, and it's right back to where you sold it. So
yeah.
yeah, you could have gotten more, but uh, yeah, top ticking. It's just not
Yeah.
not something that we do that often, right?
Okay, it's always about hitting that sweet spot, right?
Yeah, getting the heart out of the watermelon is what Bill O'Neill, the founder of Investors Business Daily, used to say. Well, Leoš, it was really nice chatting with you. Really appreciate you coming on the program, especially since it's almost midnight where you're at. And I hope you have a great holiday, and good luck to you in terms of the end of the year and kind of sealing your spot in history as a U.S. investing champion.
Thank you, Justin. It was my pleasure.
Yeah. Okay. Thank you. Well, that's going to wrap it up for us this week. Don't Please join us next week. We've got Kathy Donnelly coming back on the show. She's one of the authors of The Life Cycle Trade. We've talked to her a lot about how well she's able to buy and hold on stocks. She's got her mental capital preservation rules. So we'll talk to her a little bit about how she handled this recent reaction this week, and see what stocks she has on her radar, because there's a little bit more happening in the IPO market that might be worth watching. So we hope you join us for that. We're going to be live 5 p.m. Eastern on Wednesday, 1 week from today. So that will be on the 18th. So hope you join us. See you next time. Bye now.